So let's begin with the big issue, an uncertain outlook for earnings.
If you think about the arc of earnings season, you start out with banks.
Financials.
The financials. These are very clean, well-run stories that throw off a ton of cash.
Frankly, we think the risk is investors get lulled into complacency, thinking that the margin risk isn't out there.
The curve is steepening.
And, oh, by the way, the valuation has been depressed.
The back half of earnings season is industrials, it's tech hardware, it's all of the sectors that are most exposed to the supply chain issues we've seen, to the China trade issues we've seen.
The China risk is just all-encompassing when it comes to tech.
There's absolutely increased uncertainties.
Trade tensions are pretty much here to stay.
So that's where we think you could see some more substantial earnings cuts given the margin pressures.
So the key question, how to price the full impact of trade tensions on corporate earnings. Joining me around the table, Andres Garcia-Amaya of Zoe Financial, Chris Harvey of Wells Fargo Securities, and Barry Knapp of Ironsides Macroeconomic Research. So, gents, you know how this works. You have your prize. You confirm them by cherry-picking the companies that you think fulfill your narrative just a little bit more. And we can do that quite easily, can't we, Chris? Pick out the banks. Consumers are strong. Pick out CSX and Union Pacific this morning about the outlook and say trade uncertainty is the problem. What's the real story?
Well, the real story is it's uncertain. It's murky. You're right. You're absolutely 100% right. If you're a bear, you can find bear stories. If you're a bull, you can find bullish stories. But now the question is, how much is yesterday's news and how much is going to be with us longer term? How much is inventory and an inventory rush? How much is uncertainty? And as we go forward, does that uncertainty clear up with trade détente? How much does the Fed help us out? And I think for the most part, a lot of what we're seeing in earnings is yesterday's news, and you're seeing a bit of forgiveness.
Well, let's talk about this morning's news. Barry, the Philly Fed Index, not something that should be shaking up markets in a big way, but firmer. Put it together with US retail sales, firmer inflation. The picture for America still looks okay, doesn't it?
It does for sure. The regional Fed surveys have followed a pretty interesting path. I like the capital spending plan 6-month forward component of those 5 reports: Philly Fed, Empire, Richmond, Dallas, and Kansas City. And it's been a very good, reliable indicator 2 quarters forward on capital spending. So it was strengthening through April and surprisingly held up in May, despite the tariff breakdown of talks that started in the beginning of May. And then in June, it just hit a wall. Well, it looks like it was pretty transitory because that part of both the Empire State and Philly Fed survey have come roaring back. But more to your question about the domestic economy, you know, there's this concern that global weakness will bleed into U.S. growth, and I just think that causation is completely wrong way around. What actually happened in the U.S. was we had a wealth shock associated with a fourth quarter stock market crash. Retail sales, core retail sales went negative, the second most negative reading in the history of the series since '93. Obviously, '08 was bigger, but it's come back to an 8 or 9% annualized rate, and that consumption. One of your earlier guests on the radio this morning thought that we'd have 4% core PCE, personal consumption expenditure spending in the second quarter. So you had an inventory destocking cycle. That's almost run its course. That's why the numbers look sloppy at the rails. But the core organic growth numbers for Honeywell and the other industrials is really good.
I think it was Tom Porcelli of RBC you're referring to.
That's
He's looking for a pickup in consumption, personal consumption in the back half of this year. Your thoughts on this all, Andres?
Yeah, I think I would agree that the U.S. recession, when it comes, is going to be self-inflicted. It's not going to be because of China. It's not going to be because of Europe. And that's going to be continue the story. So we need to continue to look at the domestic numbers, and the domestic numbers don't look bad at all. I think looking at the economy versus earnings, if anything, things kind of flopped, right? The we were worried about the economy coming into this year. We're going to head a recession, but earnings are super strong, double-digit earnings. And now it flipped, right? Now we're like, well, ignore earnings, they're bad, whatever, but the economy's doing really well. So I think the market keeps looking for an excuse to justify earnings, multiples, considering, you know, where they are.
What do you make of the narrative that Dan Skelly's talking about over at Morgan Stanley at the top of the program there, that the arc of earnings season is as follows? At the beginning, it's the domestic players, which tell you consumption is okay. Then the back half of earnings season, it's about the supply chain stories, the hardware and tech. It's about the industrials, much more so. What do you think about that?
Well, look, there's 2 main drivers for the markets. One is earnings, and then the multiples you're willing to pay for those earnings. I think the story continues to be that central banks are pushing interest rates now lower, and by definition, that means that valuation is actually getting squeezed higher. So this year is going to continue to be this idea of, can we justify these multiples? Should we even have higher multiples, regardless of what earnings do, unless they really, tank?